Meanwhile, the market has been tumultuous under the surface for a while, and we've talked about, you heard Mark talk extensively about the software concerns and how much that's really impacting private credit in particular. Where are we in that washout? Do you have a sense of how far along in terms of recognizing who the winners and losers are going to be in the software shakeout?
Yeah, and I think Mark spoke to it. When it comes to private credit, we saw the Blackstone headlines overnight. I think that's going to take a while to work its way through the system. I think we're going to continue to see elevated redemptions. I think some of these structures are going to come under pressure. So in publicly traded BDCs, they're trading right now on average at about 23% discount. The private BDCs and the interval funds have to return capital at NAV. And the rotation is going to be redeem those private BDCs and interval funds and transition to the public BDCs. You'll get a higher yield even if the NAV discount doesn't close. So I think you're going to see that. And I think ultimately what happens there is it's going to put pressure for there to actually be secondary sales in private credit. And the other thing with private credit is, not all funds are created equal. Some funds have disproportionate amount of exposure to the software sector. And again, I think within the software sector, this is a structural re-rating that is deserved. So I think really doing your homework on where what kind of exposures the underlying has is going to be really important. I also think investors, big endowments, high net worth are over allocated to private assets. Their private equity isn't cash flowing, and now they're going to have a similar issue in private credit. So I think it's going to be a painful 18 to 24 months.